Welcome! How about that? I love it. I just love it. I hope you enjoyed it as much as I did. Yes, we've got a great show for you today. We're streaming, and we're streaming about gold. Yeah, everybody talking about gold now. We're going to be streaming about silver, the gold-silver ratio, misunderstandings about what we say when we talk about phase one for gold. We're going to clear that up. People don't understand. People don't understand. And we're going to be talking about the energies complex. We took a lot of heat at one point, cautioning on uranium, and of course we're short oil. We're going to talk about all of these things and the debt markets. The debt markets. It starts all with the debt markets. I hope you enjoyed it. It's an absolute classic. We'll see. Hit the like button. They might not like we played somebody else's tune for a small moment at 25 times. Hit the like button so that the algo doesn't kill us for being good, bad, and fugly. Like the debt markets. Let's go. Let's go. Let's go. So, actually, good people, right here, right now, the macro is super bullish gold, and it remains that way. However, technically, on a short time frame, you are just after a very, very key surge in the gold market. Let me get my draw tool out and show you what we've got to watch out for. A big surge came thanks to all the dump and pump that came with Drumpf. Drumpf brought a pump and dump scheme. Of course, he whispered to his insider cartel. One of them, Mr. Schwab, made 2 billion. He even told us how much they stole from you. And the other one made 900 million. Isn't that sweet? The insiders. You've got to be close to the cacocracy insiders to get the playbook. And then you buy Apple calls on the day of expiry for a cent, and they become worth $12.50. How does that even happen? Oh my goodness. That's Donald Trump. 1 minute. Let's get to the bottom of it. Sorry about that rude interruption. You've got to quit your messaging systems when you're on a live stream. Sorry about that. Hit the like button. This could be a pennant, guys, but it could also be a little bit of a structural top that could have a tiny bit of pullback or a little bit of sideways action. Macro is bull. Medium term is bull. Short term, careful about rushing in leverage long right this very second or minute or day with that. We're on, of course, the daily time frame, the typical time frame. We're going to bring it down to the 4 hourly. Here's what we'd like most to see. A little bit of a squeezy Japanesey, something like that. Carry on around, even sell off a little bit. Come along, calm down, and we go again. We go again, and we're going to keep on going because it's 40 years of debt adding that has to be unwound, deleveraging. And this time, there's a couple of key, I want to do a few things different on this stream. I'm actually going to take you to other people's tweets that are interesting, saying interesting things, for example, and have a look at what they're saying that is real, how the mood is, and also the extent of what we learn about the markets generally from other people. And there's a lot of guys worthy of a follow, so maybe I'll dump a few of those. So here's what's happening. You've got to understand with Goldman Sachs workers, they're in the Russia bad narrative. So let's just cover a little bit of this. This is Robin Brooks of Goldman Sachs. You've got this, and he's saying, this is what's happening in the tariffs game, by the way. Russia bad, you can see March 22, and then you see what's happened. Europe, Britain, France, Italy, etc., squeezing their trade right down. Germany, light blue line, squeezing their trade right down with the bad nation that is Russia. They're so bad, you know. You keep saying that, I start liking them, of course. And then, of course, who benefited? Well, China did. They've just had a dip because of their new year that continues up. The trade has been moved from the great West, the collapsing European West, to the rather doing better, I would say, long run, although at the moment, rates real low in China. They're keeping that one. This is now all about trade. Everybody's wanting to hold on to their trade. And whose currency goes up then? The euro. The euro is strong against the Chinese yuan, against the dollar, because they haven't a clue and everybody's fighting for the trade war, and it's the worst time to have a strong currency. And you bet it, they got it. Also the pound, by the way, and that's not a healthy strong. That's a future debt devaluation strong. See our video with all the upside HVFs on the 10-year British, the 10-year German, the 10-year France, the 10-year Netherlands. Okay, their debt devaluation is coming because military-industrial complex. The people that live off all the bungs, the backhanders, the brown envelopes that goes with arms dealing, you know, that very honorable job of arms dealer to the big parastatals and the weapons dealer, you know, the people that love a bit of war and carnage and a bit of bombing, and, you know, they love the smell of napalm. What can we say? Those guys, they need their new, their new clients if America's going to be winding it down a little bit. And of course, the Eurozone has been set up for that. So that's the Russia bad story a la Goldman Sachs. That's what you're typically going to get. Now, what are we seeing here? We're seeing a bit of 3 months Treasury concern. So remember, if you learn anything about this channel, the first things you should always say, and you should know that we will say and reiterate until we get it into everybody's heads, it's a debt-based collapse. 2020 was the turn. 40-year bull market over. The overdraft is pulled. The bottomless overdraft is pulled. You now have a limit that you have to live within. And for America, that is very uncomfortable. And that starts to mean every spending means it's at the expense of something else, where you could just keep building. So US 3-month Treasury, 4.87. That's got a little bit peaky, signaling liquidity concerns. Liquidity concerns is a fancy way of saying there's no bloody buyers when we need to sell. That's how it is. You want me to translate fancy financial speak to you? It goes like that. That's how it goes. Okay, what else has been interesting that we can tell you about in terms of the overall Twitter sphere? The global net gold purchases by central banks. Give Kobisi Letter also a good follow, and often see a number of interesting things up there from them, and it's always worth checking in. Global net gold purchases. Here we are. This is where we're looking, friends. Global net gold purchases right here in the transgender pink, and this marks the 20th month. So we're talking virtually going in a few months' time, and I will guarantee you we'll get there. Even though I don't know the future, I will give you a 99% probability that you'll have 24 months, 2 years of every central bank buying precious metals. Initially the gold, but this one's day will come. Can I clarify? Just because we say gold first does not mean we're a bare silver. We buy silver with our gold, but put a disproportionate by value in gold first, and then we'll even pivot some gold into silver. You must stack silver. Now, you never know whether you'll be able to do it when the gold-silver ratio smashes through 75. They might just say, it's become a strategically significant way. Of course, it gets used in the military-industrial complex. They don't want that to be too valuable. It gets used in the iPhone cars, also known as Tesla, for the track and trace and surveillance or monitoring of you. It gets used in solar panels. It gets used so much and is so critical. But initially consumer wrecked. It's also the people's money, while gold is the king's money. The central banks buying gold. We're chasing and riding the big money first, guys. That's why we're saying 75% into the gold, 25% in the silver. You play the first half of the match and you have half an eye on the second half of the match before the bomb squad comes on. Yep, the bomb squad comes on the second half. That's when the substitutes come on. You can see a Springbok rugby fan a mile off. So the 25% is for the second half, when it absolutely kill it and you rack up all the points on the board. But you play the first half. You can't concede. You've got to win the first half too. Okay, that's how it goes. And the central banker is the big money that we follow first. We follow it first. When industry is being collapsed, that's why oil's trading down, by the way. We'll come back to that point. When industry and consumers are wrecked, You chase the king's money because it's the billionaires that are running into the king's money, and the central banks, the major hedge funds, the home offices. You've got to follow each stage to maximize. Understand, we want to maximize. There's stages to this and a process. This is showing you central banks haven't bought 20 times, 20 months in a row the silver. It's much more you have to buy to put the same amount. It's less liquid, and it takes an absolute god-awful amount to store for them. So it's not their tool. Move with the first mover, the elephant. Then we follow as we go down the chain, the smaller sizes to the people's money, which will overperform, but initially will slightly underperform. Okay, so that is 20 months. We're 4 months away. And I'm virtually saying it's going to happen with almost assuredly happen. Now, this is the energy complex. Now, when we saw this chart, we warned that it's not the best chart. We were always bullish uranium at this point. But then when we got this, we said, careful here now. You may actually have a sell-off. We were wrong on timing. It didn't sell off. It went marginally higher. Note, that's marginally higher than there. Only marginally so. We warned it's a marginally higher high. It's not because we bearish uranium. We weren't bearish uranium down here. It's the logical choice for energy generation. It is the most, the cleanest, the best value, and we should be doing nuclear energy, and we should be even going to localized nuclear energy. But when I hear, and I love Rick Rule, he's a great guy, great guy, but I would say, gold is the ultimate, by far the biggest trade, because energy goes down in use when you first killing and deleveraging a worldwide economy. So when China is producing everything, they need a lot of energy. So the producers consume a lot of energy. A growing economy produces a lot of energy and needs a lot of energy. But when you are getting to a point where you are no longer building more stock and you're building up inventory and a consumer is wrecked, the trade is not an energy. And this is what this gentleman is highlighting, that this is a worrying breakdown, an M top. Yes, you got a little bit more, and now you're at roughly where we were warning it could be dangerous for uranium. And the energies will underperform the precious metals. Uranium is the best of the energies and should be done, but there's a lot of misinformation, climate change garbage, and anti-nuclear after the Fukushima, which was an orchestrated event in my view, and a lot of other things. So we should be more nuclear. It's not about what's morally right, it's what's going to happen. If we are reducing on energy, the energies get sold off. Hence, our oil short, gold long trade for the second time. We will show you the charts on that, but we are going through the Twitter vibe. So just understand this. A growing worldwide economy consumes more energy. Energy goes up. It's like an inflation tax when everyone's making lots of money. It skims a little bit. But when it contracts, it drops down. It's like a thermostat on your heating. When it's hot, it automatically adjusts down. You use less of it. So a contracting one of reduced production consumes less in a worldwide economy. And when you are going through a financial deleveraging, refer point number 1, debt-based collapse, which will not be stopped. This time is different. You heard me say it. I just said this time is different. They say, beware the guy that says this time is different. The key point, no bottomless overdraft. The difference between 1987, 1999, 2000, 2007, 2008, 2009, and CV19 2020. So 87, 2000, 2008, 2020 is each time they were in a position to dip into, hey, you can trust us, we good for it, bottomless overdraft expenditure. After the subprime, they didn't do enough. They had to do QE1, wasn't enough. They destroyed. It was a depression. Let's be frank, it was a depression. They destroyed the consumer entirely. They did a QE2. It still wasn't enough. Hey, QE3. Hey, let's play with the duration, a twist. All of that. That's what it took to engineer a very slow recovery, very inflationary, destroyed the consumer, diluted a lot of your currency by proliferation, but they didn't do enough. Come CV19, they just went straight to the trillions. Yep, that's the lesson they'd learned. More heroin, much more heroin. He didn't come around. You've got to really give him a high. Boom, 7 trillion to the people, and the 21 trillion they didn't tell you about that went to all the banks. That's how much fiat was created. That's how much debt is out there for those that truly understand it. This time, in this crash, the same level of access to bottomless credit no longer exists. In this time, let me repeat it so that everybody gets this clearly. We do not have the same access to credit because somebody has to buy it. Somebody has to buy it. And you didn't have enough fear for all of it. And here, Jordan, I'll give Jordan a shout out. We've shown up on his channel. And he's done a nice chart there. So let's give him some credit. Give him a follow. The Daily Gold. Jordan Roy Byrne. Have a look at what he's saying. Too many are stuck in the 20 and the 2008 playbook. 100% correct. Ad.com in 1987, depending how far back you want to go. This was not the case. Bonds are in a secular bear market. I would even go further. They've had a very disorderly collapse in the last 4 or 5 years. That's not even a bear market. That's a spiller. It's a thriller. It's a capitulation, and it's disorderly. It's not a trend down. For a huge chunk of the 70s, precious metals were inversely correlated to stocks and bonds. Your insurance for debt-based collapse is gold. Let me say that again. Your insurance for debt-based collapse is gold. Pure gold, link below. Bullion Vault, link below. Accumulate $10, whatever you can. Put 75% to gold, 25% to silver. When we break the gold-silver ratio down through 75, we'll pivot it to 100% silver. You will be accumulating and stacking both by value. Okay, so here we go. The 2008 boogeyman has conditioned everyone and their dog that there has to be some big decline before precious metals can go higher. Precious metals is the alternative to the debt that is being dumped. Let me say that again. This time is different compared to CV19. You had a sell-off, not very long and not very big for gold, worse for silver. This is now the only alternative. There might be a bit that gets channeled into the crypto markets, but it's been relatively underperforming and is a much smaller by liquidity market. You're looking at a 22 trillion gold market now, 21, 22 trillion, not the latest number, but they're around. So what does that actually mean? Here's his chart, and it's a good one. So have a look at this. So he's got up there the stock market total return, and he's highlighting in yellow. And the bonds total return. So this should be talking very much to the 60-40. Now, people will wonder what's 60-40. I want to make this absolutely clear. Most retail don't understand or know much about the 60-40, but it's kind of the cookie cutter template for hedge fund and asset managers for people for decades coming through the 80s. And it's, when Tony Robbins suddenly decided he's no longer just talking about head swelling and bodybuilding and ice baths, and he wanted to become a financial guy, he learned about the 60-40 portfolio and did his book about becoming rich, etc., and went and sat in Ray Dalio's lap and had a little chit-chat. So he learned about the portfolio and started talking about it. That's how I knew also it was the end. By the time retail motivational speakers are talking about 60-40, you know it's time. It's time, it's up. It's time, it's over. Anyway, what he shows is the S&P was flattened down. Remember, in an inflationary environment, that's negative performance, as you got here. But in the 70s, it was accompanied by a bond-based collapse. Volcker had to whittle away the value of all the debt created in the military-industrial complex in Vietnam. That's what he had to do. And who was getting rich out of that? Kissinger, his cronies, the arms dealers dropping bombs on jungles. You know, that super productive activity where you don't even kill your enemy, you just make holes in somebody else's ground. and then somebody gets paid for filling them in later. That's it. And you maim a lot of your own citizens for a little bit of population control, and you help another country also do a bit of population control of its own accord, and they buy arms from somebody similar, etc., etc. This is what gold did during that period, is what he's highlighting. He says there's the breakout, and that's the general performance that you got into the 80 high. So here's what the point he's making. The point he's making is this turned. Any stock market sell-off, and this doesn't have much of the stock market sell-off in it yet, I'm not quite sure why, because I think it's already lower than that, will be more like this period here, these two, than anything you've experienced before. That's why he's saying it's not 2008 all over. It's not, okay, let's just wait for the printers and pumpermentals. Let's catch some falling knives all the way down. Get ready to buy Apple and Mag 7 and get ready to do this. And gold's going to dip, all of that. It's not going to dip like you think it is. It is the alternative to bonds. It is the guy in the room that's the same guy he always said he was. While bonds have fallen through their own backside. They have lost so much real value and are destined to lose even more. And the wall of borrowing is pre-committed and huge. You have 9 trillion before April next year to refinance before you spend $1 on all the already committed projects in America that Trump really has no discretional power over anyway. The discretional spending is incredibly small in comparison to what's already pre-committed in spending. You can't stop everybody's pensions. You can't stop everyone's Medicaid that you pre-committed. You can't stop giving food stamps. You can't stop doing all of these things. Or if you can prepare for the riot that comes. And eventually, I think some of that will be done. So that is why it's more like stagflation era, only it's a hypercharged version thereof. It's an even bigger, worse option. That's what's going to happen. It's going to be, when we talk, you saw the theme tune. The man, the fugly, this is the fugly, guys, the debt. It is absolutely not just ugly. It is wreck. It is a train wreck. It is that bad. It underperforms and out destroys a nation and many around it. This is the falling of the West, and there is no new money to come in. Everybody goes, but melt up soon. But melt up. Melt up means there's a wall of money being injected in that is taking out all the offers and chasing up the market. And for the stock market and the bond market to go into a melt up requires a huge bid stack to be formed and a chase all the way up, not just to return. It's got to go up probably 20 plus% just to return. It's fallen 20, so it will need probably 24, 25%. That's how much you've got to climb to reclaim. Where's the money coming from? If you want to say QE, well, that means the Fed's got to issue more bonds. The Fed's got to issue more bonds. Who buys them? When you issue debt, somebody is an owner and somebody has it as a liability. Asset, liability. Do you want to own it? Do you want to take the products of securitized mortgages, people's mortgages? The banks are rejecting 42% of applications of refis on houses. The banks themselves. They don't want to create that debt. Remember subprime, how much they were generating? Hey, sure, you can have a mortgage. Check it out. Sell it all on. It's not sitting on my books. It's garbage. I know it's garbage. Everybody knows it's garbage. But you'll package it up and say it's a great asset. Now, they've got to sit with it. Nobody wants it. Everybody wants to know who's going to buy it. If you can't get a seller for it, you don't, and it's going to sit on your books, you're very interested in the capability of the man to pay on what is now perceived as a hypervalued market. The banks have changed their take. They know the debt market has turned too. And that means everybody gets to be deleveraged. The retail does too. Eventually, the knowledge that we gave you in the end of 2020 gets out to everybody. And the CEOs of the banks know, and we're waiting for this crisis to turn into a bank, hedge fund, and institutional-based crisis. This is the beginning, my friends. It's not even the end of the beginning. It's the beginning of the bull market in precious metals. It will lead with gold being the best performer, and at some point it will pivot into silver outperforming it, and maybe even platinum outperforming them both. Start with the gold. That's how it works. Here's where you are. You're in a bigger version of that, waiting for that. And by the way, you went from 20 to 35, and then you went 800. That is going to look small by comparison. How can you say small by comparison? Are you being a drama queen? On what do you base that? So every statement we say must be based in something. So let's go and explain why we say it will be bigger. Apart from the fact that the numbers are bigger, apart from so many aspects that are really, truly bigger, do we have any real justification? Well, I want to show you a chart that we did. Let's have a look. Gold silver ratio, Dow Jones XAU. Now this went out on X. You can see it on X. Are you following us? At the market sniper, at the crypto sniper. Let's show you this. What are we looking at? Let's understand what are we looking at. Why is the crisis going to be bigger? Okay, 2 points are going to be made out of this chart. 2. Do central banks bring stability or volatility? I'm going to have you answer that question. We're going to start before the Federal Reserve was created, and I will highlight to you the year that happened. 1913, starting from there. You went into the roaring 20s, the Great Gatsby, the movie that ends up with the guy dying in his own pool and depression all around. That movie, you went into the roaring 20s, and then you got yourself the Great Depression. Gold to Dow. So the chart is, let's just restate, Dow Jones, the largest 30 companies in America, priced in gold ounces. This is what you're looking at. Look at the screen. That's what you're looking at. You divide the Dow Jones by gold. At the top of the roaring 20s, it was 18.63 ounces of gold. So that's our 1/20th of an ounce that I told everybody in Aussie dollars, and everyone was telling me how I got ripped off. Yes, it was Aussie dollars when I said 500. Sorry about that. I didn't make it clear. I said dollars. I meant Aussies. So you would have needed 20 of these. That gives you 1 ounce. These tiny little specks here. You would have needed a further 18 times that 1 ounce coin. I don't have a 1 ounce here. To buy yourself 1 basket of the companies at the top of the bull market. After it, at the bottom of the Great Depression, 1.88. That is essentially 1/10. 1/10, guys. 1/10. Just think about that. And that was the big one. You know, that was the Great Depression. That was the big one, you thought, or so you thought. Then we got the big inflation from the lows of the 30s. Proliferation, create, spend. Dow Jones going uppity, up. 28.47 round about 1966. They'd started with the causing grief and the potential war in 64. It got really dark and heavy in 68, 69, 70. And then the over expenditure started to show its face. Everybody, paper assets, bit of a worry, bit of a problem. Debt, interest rates must go up. Volcker came in and did the necessary to devalue the bond market so that the stock market also had a torrid time, went very flat and nowhere for a long time. Bond market collapsed. Remember the previous chart that Roy did, the yellow bits during the 70s. That's what happened to gold during that period. Remember, gold was the one at the bottom, climbing really strongly up. You went from 28.47 ounces to buy a Dow basket to below 1. So you went up 28 times for shorting Dow longing gold. That's it. You dropped to 1/28th of what you were. That's actually 28.5, and that's below 1. So it was an unbelievable outperformance of gold. And here's why I say it's bigger still. It's bigger still. You have already done half of the journey. Now, this is the Greenspan financialization of everything, the biggest financial criminal, the liquidity experiment monkey that was praised to high heaven by Wall Street as being such a leader and dynamic man of such great policy. He ran you literally after Volcker. He took over from Volcker in 87, roughly here. and he ran a liquidity experiment. That was 1987, by the way. That was the dip. Pump, cut rates. Every time he cut rates. And there was always a bid in the bonds, thanks to the petrodollar that Kissinger put in place in the 70s, round about when him and Nixon went to go visit China to start the globalization game and bring China into the game, the future dominant force. They had to birth it first and let it start growing and sorting itself out. They did that in the 70s, uppity, till you got to 2001, 45, literally 44.93, guys. 45 gold ounces, full gold ounces were needed to buy one holding of the weighting of the 30 biggest companies in the US. Then that turned. This was your ultimate high. .com was the beginning of what is the great financial unleveraging. Everybody thinks it started in 08. No, this was peak gold ounces. We sold off. 2009 was here, 7. You dropped from 45 to 7. Then you had the 2011 depression awaiting the QE 1, 2, 3. You actually were at 5.72. Don't forget, gold had started to go up from $250 round about here. It was now moving, and this was bringing the relative valuation of the Dow down. Gold was outperforming. It started after the .com boom, when you could buy gold at $250. That was your true hyper opportunity. But don't worry, there's more to come. You're well positioned. So that was the low of the 2011. Then we got the refinancialization of 2011. QE 1, 2, 3, uppity, up, round about to 2016, when China hit the buffers on its debt to 17, 22.45. We sold off for CV19. That's the low. That's all CV19 was in gold Dow units. It was a massive event. But over here, in terms of the Dow and the gold price, not much of a downside adjustment. And in fact, we shook it off with the CV19 free money that got printed, and the stock market got pushed back up. It never made a new high like 22.45, the localized high. And since then, we are trading down. We're now at 12.61. And here's what I suspect. You're going below half. My guess is you're going to go below half. The bigger the move to the upside, the bigger the dump to the downside. You've already seen it once here. Each time they built on the leverage of the previous time. This is all since 2001's high. You are still in the corrective down phase. You had a rally after 09 and CV19, but the CV19 rally was very weak. The ability to rally, the relative valuation of stocks to gold has diminished immensely. The main way down, and remember, that was 7 trillion and a lot of liquidity that should have gone into stocks. It couldn't move the needle. This is mainly down from here, friends, and that is why you should be short the Dow, long gold. If you can't do the short the Dow bit, don't worry, just go the long gold. This is a very, very powerful trade that will take you, and this will be the biggest event. And when it finishes, it plummets, typically. Contagion. I want to highlight this phase. You got a bounce here. There you got it. How do you finish? Absolute spiller candle. What's happening right now? Major movements in the metal and the cost downside in the equity markets. This is how you have a bigger move than even CV19. That's an unpopular thing to say, because I'll tell you why. I'm going to talk about the gold-silver ratio. A lot of people misunderstanding what we're saying. So let's have a check at your comments. Thank you for all the comments. Lots of activity. Yeah, lots of activity. There are 888. I feel like one very lucky Chinaman. Thank you very much. It must be a Chinese stream. We got 888 watching right now, 34 minutes ago. And we've got how many likes? How many people are actually appreciating the fact that we are doing live streaming from the studio to give you the latest? Let's put a light on. Woohoo! More light, please. That's it. So let's go into a little bit more as to why gold-silver ratio is fascinating and something to just bear in mind. And I'm going to tell you now, someone in the comments is going to get this wrong, because I already breached this topic with Elijah on the Franklin Mint guys, which I enjoy showing up and supporting them, and they support us as well. We appreciate it. And I've already seen some of the comments that misunderstand this. So let's go to the gold-silver ratio, okay? Let's really explain this carefully so that people don't get this one wrong. So talking in the community about it. South Africa's gold output slides after brief uptick, and looking at this gold-silver ratio. So we've watched this ratio very closely, and we've sought to do good quality technical analysis on it. And when things don't do what you expect them to do, you need to review. That's what it's like, you know, driving a car. You're going through Death Valley and it's a straight road, but you know, every now and then there's still a kink in the road. And when you're about to plow into the desert, you give a little adjustment to the steering wheel. There's something that needs changing. And if there's a sharp corner, you make sure you change direction. So what have we seen? For a long time, we worked on the thesis that here the 65 was a possible neckline, this red line. This was a big blow-off head, and that the ultimate event was the CV19 event. And then we said we could get a right shoulder. We spoke quite a bit of this on this channel. But what ended up happening is when we did get our spill that we were expecting, eventually, after a lot of fake outs, it spilled just a little bit here, and we said, that's it, it could be going, it could be going. It got down to this level and it got bounced back up. It was a flush out. It wasn't a follow through. And then we said, this ceases to be like a right shoulder now. It's too scaled. It's too big. What does that communicate to us? And then we look at the gold-silver ratio and we see every time you hit around about 90, you see the orange number is 90, this dotted line, 90, you sold off. 90, you sold off. You see the orange boxes, sold off. And here you sold off and you broke that grind line, but then you got snapped back up. We said, that's interesting. We tend to sell off at the 90, but the one time we didn't was, of course, the events of CV19. This has been a reset indicator for us for a long, long time. Breaking the 90 and going beyond 100 is a reset indicator. CV19 was the last chance they got to do the mega debt print, and they exploited it to the tune of trillions, and they won't get the same depth of overdraft ever again. They've played that card. It's done. Nobody wants the assets on that scale again. In fact, they've got to deleverage and they don't have the means to do so. So we said, okay, but hold on. You saw the gold to Dow, and I'm busy saying higher pump, bigger dump. It's a broadening structure. Do you remember the broadening structure? I didn't call it that, but if we just go back to the chart here, not that one. Was it that one? No, that's silver. Where was it's the D. Do you see that this is broadening? Just make sure everybody understands. Now you answer that question. Does the 1913 introduction of the Fed introduce stability to economics and the people, or does it create banker, cartel, mercantilist, chosen ones, supremacist, pump and dump schemes to extract all the wealth from the rest of the people at the expense of and socialize the losses and privatize the gains? Which one is it? Are they a stabilizing force? Here's where they came in when you're actually during a very stable period, gold versus Dow, and here's what's happened since. Answer the question right here, right now in the comments. It's a leading question, I imagine. But if that happens, have they brought stability, or have they brought a Pumpermentals casino for self-enrichment? And I think you'll get to the same conclusion as me. These are not forces for good. They know it, I know it, and now you know it. They've introduced volatility into the system because they can get everyone surging in near the top and they can pick up all the pieces at the bottom, and it's how they can quietly strip you of everything you ever owned. That's right. and cause contagion and collapse and take all your money when you most need it. That's right, bankers always offering brollies and taking them back when the rain comes. And this is the whole system. So if we go back, this is going to be the biggest volatility move since Volcker took you all the way into, and Greenspan took over and took you all the way into 45 gold ounces to secure one basket of Dow shares. You are going to have, since then, all the way down to wherever we end up down here, which I suspect is below 1 and possibly below half at some fraction, you are going to witness the biggest unwind ever. Now, if we are saying that, that means a big spiller still has to come. This is log scale. We're talking about many, many decades. We're going back to 1890s. Please recognize that. If I delog it just quickly, you can see that pretty quickly. This is a log scale view. We should not underestimate how it looks, though, in regular scale, so that you can see how big the blow-offs were. So what does that say? If we're going to have a bigger collapse than CV19, this was the collapse at the end of CV19, by the way. They could only pump the Dow. They couldn't even take out the previous high. Now, admittedly, a lot went into the NASDAQ, but the NASDAQ hasn't been around as long as the Dow. So you could argue it went a bit higher against the NASDAQ. But that means you've got further up to fall from. So when we go back to the gold-silver ratio, I don't think it's unrealistic, or at least safe to say, that there is a possibility that the gold-silver ratio could in fact take out the previous high. And when we draw a pattern up like this, and we go, wow, this is a second impulse, and that is a third. And that was a triggering event, the tariff story, and you've had a blast out through the one, and it is not as blow-offy as that. This is still moving moderately and having a pushback. We'll drop and watch a time frame. This could trade like it did over here, grinding and climbing high for quite a while, and then blow off to do 175. In short, we have a form of HVF to a very high possible. Possible. This is not a prediction. I'm just warning. It's a possibility. A small, let's say a very small possibility. It can turn and go back down and everything's hunky-dory. It all could be good. There's a small possibility. And we stopped talking of this as a head and shoulders. When we drew this, we said this is more like continuation. We warned everybody. This has turned into continuation. There's a crisis coming. And we've used the gold-silver ratio to predict crises. It's like the USD JPY. We have to talk about fear indexes. We have to talk about the US 10-year yield. We watch that. That is a demand-destroying event. A month ago, when we predicted the demand-destroying event starts before June, the end of June, it started within 2 weeks. And what told us? The breakout here. We saw this potentially going to the upside. And we saw it breaking here. When it broke out here, we said, this is not good. But it's different this time, because it's not on gold going down and silver going more so. It's on gold going up more so, and silver still going generally up, but gold more so. So this is not a bear call on silver. It's a super bull call on gold, and a somewhat bull call on silver, later to become a super bull call on silver when you pivot back and we head back down. It may make 175, patterns can fail. It may not. It may not even make this time. It may fizzle here and the pattern fails. I'm just warning, trade the phases in front of you. The first phase is the gold phase. The people with the money move the market they move into. The people with the money are the multi-billionaires, centimillionaires, hedge funds, home offices, and central banks. Are they buying silver or gold? Right now, big money goes to gold. I showed you the tweet, 20 months in a row into gold. Big money is going into gold. There is so much in the debt to unwind, this phase may last longer than you think and could even become more extreme. But inside of that, silver still could have gone up. So you could be looking 175. Some of you are going, wow, that's crazy talk. And even I think so in some ways, but I just want to do a sum for you. Silver could go up to $50. Do you see that? Pretty bullish. Anyone be upset about that? Not me. And if you applied 171, that's the value I got. A different platform's given me a slightly different one of 175. Gold could be 8,500. Gold could be 7,500. Gold could be 9,000. And silver's still at 50. That's not a bear call on silver. Do you understand that? Everybody's saying, he's bearish silver. No. And by the time that turns and starts coming down, it'll come down so fast, so violently, you might battle to get silver. But you want to pivot. So here's what I do. 75% of value into gold first, 25% into silver. You'll still have more stuff when it comes to the silver because it's bigger and much lower value. To ensure you never get caught out with unobtainium. Each month, 75% gold, 25% silver. When we break the 76 level, that has turned into a bit of a key level for us. When we break down, on the way down, whether we get to 175 or not, 100% goes into silver. Do you see that? Do you understand that's not bearish silver? It's both going up. Gold overperforming first stage, silver overperforming second stage. Two bullish calls, but trying to understand the degree and the rate thereof at different stages as we go through it. Everyone got it? Say, aye, Skipper, I get it. I'm not going to be an idiot in the comments and say, this guy's a bear silver. How can you be a bear silver? No, no, no. Keep buying silver. Bullion Vault below. You can use any of the Singapore over London for me, or New York, and even Switzerland. But Switzerland's pretty decent place for you to choose your vaulting. By the way, get to 5 or 10,000, sell it out. You get all the upside while you dollar cost averaging in. Buy yourself a chunk for a couple of grand from pure gold or ITM trading. ITM trading, if you're US, link below. Book it, support the guys. You will pay what I pay. No embedded costs, no anything, okay? So you will pay what I pay. That's the deal. So that's a little thought. That's a new thought because we've been warning about this. This was not a bearish structure once we started to do this, and the breakout here was significant. And we've warned the head and shoulders option is no longer looking that way. We've got to get worse before we get better, possibly. Not guarantee, it's one scenario cost, not a forecast. It's a scenario. The other scenarios, you run out, you fizzle, you come back down, you bounce, you muck around here, and you break down and you bounce on 65 after breaking 75, and then you spill. There's plenty of other scenarios, okay? Just warning, don't be in a hurry to overplay your hand. Some people who are late to the gold move suddenly think, I hate chasing things that are high and expensive. You don't know what expensive is. You don't know how much debt has to come out of that system. You have no idea. It's not expensive. The proven trend is your friend. This is an unwind of 40 years of malfeasance and debt buildup. Never mind the derivatives complex. Never mind all the things you don't know that have to be exposed and washed out, and all the criminality and everything else you're going to discover only in hindsight. Never mind all that. You don't know what's expensive for gold. You truly don't. And you don't know how destroyed a fiat currency can be, that it becomes more trivial and less solid and hard as a currency. You've not lived the rand. You've not lived the Zimbabwe dollar. You've not lived those things. I saw the rand be twice the dollar, now become 1/20th of the dollar at its worst point. Twice to 1/20th. Yes? I've seen that. That's fiat. That's what fiat can do to you. And everybody seems to get their turn when it comes to fiat. And this is the season of all the lepers that kiss the chief leper to join the game, to get all their turns simultaneously together. How convenient. It's almost as if someone would want to introduce a new financial system that they would do that. That's such a conspiracy theorist. Anyway, never mind. So back to that. Did you all understand the gold-silver ratio aspect? Now we need to look at oil. And we said to you, it's going to go. We were early, but not wrong. We were also early on uranium. We were wrong on the direction of it, but we were initially, but it's now giving it all back. We showed you on the tweet. So let's have a look at the US 10-year. The big happening, friends, fellows and countrymen, the big happening was dollar going down on rising rates, debt going down. Remember all the seesaws we did for you? Rates up, debt valuations go down, currency goes up. Remember all those seesaws we did for you for all the different currencies? Then we showed you the UK one. The UK one, I'm not sure I still have it. Let's have a look to see if I've got it open somewhere. I'll have a look. It's on the other screen. The UK one suddenly broke with Liz Truss. Do you remember that? Both the currency went down and the debt value went down. That's called loss of faith. Loss of faith event. That's what was happening at that point. It's a while ago. I'll have to open it. I'll put it out on the tweet. And it was the British debt, the gilts and the seesaw broke. Both were underwater. There was a water level in my fishbowl and somebody got a chance to breathe than the other guy. That's how it was working. America, and we said at the time, this that just happened for the UK, that we've drawn for you here, you will have such an event coming for the United States of America. You just got your first moment of that. And it's the first of more regular occurrences. Why? The debt. It's the debt, stupid. Money is borrowed into existence. Remember that. Tell all your friends. Money is borrowed into existence. And what happened? You went down to 3.8. We saw this as a bit of a head and shoulders. It was clearly the economy's weak. We're going to sell off. That's what we said. Which is showing how weak and the fact that you're in recession. There was our shoulder and there was a triggering event with a gap. Everything was going down. We said, we never buy bonds. We'll never go long bonds, but we were saying rates are going to go down, bonds might go up if they go down to this level. And this showed us, no. Dollar down, Dixie down, below 100. We'll put the Dixie on as well soon in a second. And whilst the dollar was crashing, this was going down. And some people will say, oh, it was Japan who sold their treasuries. It was China that sold their treasuries. They still hold huge amounts. Nobody meaningfully on any great scale sold. I'm telling you, institutions inside America would have been selling debt and equities to get out and might have been buying gold, which is selling the dollar. You could just have hedge funds in America, family offices in America, selling T-bills and buying gold. Who gets sold? The T-bills get sold, the dollar gets sold for gold. The biggest anti-dollar trade is buying gold, friends. Listen to me say this. Look you in the eyes. Look into the eyes, no bespeckled blue light glasses. The biggest sell of the dollar is when you buy gold. That's right. Especially if you start by selling investment treasury bills and going into the ultimate preservation asset, no longer return on capital, the guarantee of return of capital. That is the game. And we're going to keep preaching it until you get it. And these are the key themes and trends that many people are misleading and confusing so many people on. And it is about that. That is your Dixie. That is your Dixie. That is a crash from over 109 down to sub 100. But for all those beating up on Brent Johnson right now, just be warned, this is an increase in volatility. This is an increase on volatility in the FX markets of great levels. And euro is getting unwelcome strength when everyone wants to retain competitive manufacturing advantage in a recession that's turning into a much deeper, larger, greater recession stroke depression. The euro is obviously going up. That's the last thing you need. If you're Germany, you're selling Mercedes and BMWs or Volkswagen cars or Lamborghinis for that matter and Bugattis, and your currency is climbing and your energy costs are climbing in an environment where energy is actually crashing. But you're paying, Britain is paying 4 times more and Ed Miliband, family member, father, grandfather, Bolshevik, you know the kind of that popular communism, Bolshevik communism, is concreting over gas reserves and importing it. Must do net zero, must do climate change themes, must do this. He is an orchestrated destroyer, along with Starmer, of the United Kingdom. As Merkel, everyone else in Germany that have taken all the non-economic, non-preservational steps that have undermined and destroyed Europe. You need to leave the West. You don't understand what is coming and how they are intentionally collapsing this economy. They want their Messiah. They want their new world order. They're desperate to get it. The sooner they get it, the happier they'll be. So let's go and have a look at that Euro USD, and then we'll take some comments from you all and see how you're doing. This is unwelcome strength. We've actually had a period of quite low volatility in FX recently. Let's go back to our Dixie. You can see that actually this period has been kind of low vol. You may remember we were calling this as an upside HVF and the euro to get stronger. Then a whole bunch of things intervened that turned out wrong, and now we're getting the bull move we expected. It's almost like the demand destroying event got pushed out a little bit. We were ready for pound and euro to get stronger. We put those HVFs out. They were here and it started to move. No. First a flush out to the downside. Now we're getting our upside move. We saw the debt markets do it. They did a return move before they went. Here was much bigger volatility in currencies. Look at these swings. This has actually been recently along here a relatively stable period. You don't know the extent of the volatility, and if we get debt-based collapse outside of America and renegotiations, where BlackRock, no doubt, will be supporting and fronting for the United States of America and Donald Trump, having bought the Panama ports on behalf of Trump, telling them to do so. You can just see Trump telling Lowell Finkelstein, the guy managing God knows how many trillion of everybody's assets. You gave too much power to those goddamn asset managers. You ETF buyers, you've made them the proxy kings for all the shares, your money. You just got to make the money, and they've taken your vote proxies and they've bullied corporate America. Go see what Nike said in the belly of the beast when the BLM started. They didn't want this. They didn't want this George Floyd thing. They didn't want any of it. They were told. You don't hate BlackRock enough. Hear me now. You do not hate what BlackRock stands. They are 10x Goldman Sachs. They are everything. State Street, the rest of them. Okay, let's have a little look on a couple of the comments. Check out our book lists. Thank you for sharing that. So I'm eager to know how Francis got his worldly wisdom. Lots of reading, lots of interest in the markets, and a hell-bent determination to get to the truth of the matter, not the official story. You've got to want it. Peaceful stroll in the hills above Sterling at the moment. Should have brung me gold pan by the sounds of it. Impending doom amongst the calm of nature, living life at the extremes today. Enjoy nature, be in nature, enjoy life. It's the most important thing. You get one of them. Enjoy every experience, but understand other people have assumed power on your behalf in the name of keeping you safe, that do not have your best interests in heart. This is a financial war against you. It's also been a biological one against you. You've got to realize there is real physical threat and financial threat right now. The great taking is a thing. Mr. Webb's, most of the time I see him, he seems very parallel to our narrative. This gets worse. Rallies should be shorted. That's not to say you should all be shorting. No, what I mean is they're going to fall. They will create periods of calm. This rolls into a banking collapse, and much bigger, guys, much bigger. Are you clicking the like button? We have 1,069 of you watching the stream. Tell us if you like the stream where we do it interactively with screens and draw tools. Hit us a like. By the way, mini series. You're the first time watching this, or recent, you've only started watching the Market Sniper, you think you're learning something, there might be something going on in there, click the mini series link below. You'll be opted into our newsletter one a month. If you're lucky, we do a mid-month. I might do a mid-month this time. And it's a full micro trading course with a video dropped every day, 2.5 minutes to 3.5 minutes odd on average to watch. That isn't a lot out your day. You learn something about how I learned technicals, tell you the fundamentals before you find out the fundamentals. You're the last to know the narrative. Never act on news. Never act on news. You're the last to hear. So remember, still bullish silver. Keep accumulating. Over accumulate gold for the first stage. We'll totally over accumulate silver for the second stage. Our community members will be the first to know when that pivots. If you want to book a call, click the link. Book a call. Have a chat. We've been on this channel since 2009, friends. We look after our people. They matter to us. We aim always for full integrity. There's no bad stories surrounding us. I've seen bigger channels explode and disappear, start crypto pumping, start doing weird stuff, trying to get people to invest in scams on the side, all sorts of things. This is a high integrity channel where our goal is to help you build wealth in reset times where things fall a lot faster than they go up, and there is opportunity for you to build in that period, preserve wealth, and also, third and foremost, secure yourself as many freedoms and high standing status and optionality in a world gone mad, seeking to rein your freedoms in and moving towards a Bolshevik totalitarian state. If any of those three things are of value to you, you should be registering for the micro series. Get those 7 or 8 videos, pop a couple of minutes a time, bringing you to some of the principles. If it still makes sense, book a call, subscribe to the channel, hit always on the notifications bell because they like not to tell you. They like not to tell you. Let's see, Worst Among Us, waging an information war as part of their battle plan against the people. Disinformation will be peak at times like this. The last people to know, you must never know before the insiders have covered their footsteps and sold all their garbage and bought all the things worth having and stripped all the assets. This is going to be a period of misinformation. It's a fair point. Jamie Roddips, already done the call. Good man. And Anna Weyers, glad to have the ladies in the room. I can get my geopolitics and financial updates same time with a sniper. That's sniping. Kill 2 birds with 1 stone. You might even get a bit of entertainment thrown in as well. You could hear me go, ah, wow, wow, wow. That's right. You can do all of them, the good, the bad, and the ugly. And I'm telling you, it's getting real ugly, and it could get worse. And we're going to laugh our way through it. Laughter is medicine. Nature is medicine. Sunshine is medicine. Cold water plunge is medicine. Healthy eating. Listen, you were designed and built for this challenge. You weren't born in this era. You were born because you were tough enough to handle this. You weren't promised an easy life. You were promised an interesting life. You were promised an interesting life, and you were promised to win. You can win over this obstacle course, and you need to follow the key steps. Do not trust the mainstream anything. They are actively working against you financially, physically, biologically, in every single way. Look after yourself and those around you. Build community, get local, secure gold. Utilize the gold links below to thank us if you want to thank us. If you like what we say thank you for helping us. And it's the only thing we're asking you for. You do not have to engage with our community. You do not have to attend a live trading day. You do not have to become a self-study learner or a full trading metamorphosis program. You don't have to do anything. It maybe isn't for everybody. But we ask you to hit up the likes and the shares and to remember that. Let's take some questions. Absolutely. Tough. If out, I've got it. XRP, that's a crypto question. We'll save that for a crypto live stream, which we'll do one during this week. We will do a crypto, and for those of you that are interested in that, there will be some pumpermentals in that at some point, but getting the timing right. And I will not compromise on gold holdings right now. This is the primary game, guys. This is the primary game. But there will be opportunities in other spheres. Go and subscribe to the Crypto Sniper as well. Let's have a look at some more charts. USD KRW. So that's a fair question because the dollar has done terribly, hasn't it just? So did it change that? No, it did not. So that's the Kospi, by the way. It's part of the story. So here's what we think. Remember we told you about the Straits Times, the Singapore index. We expect the Singapore index to do far better than most of the other Asian index. It's going to be the acceptable face of China, Vietnam, all the proxies for China, Japan, and everything else. So there'll be listings going into. Capital formation will start to happen in Singapore, and unfortunately the Middle East, the captured Qatar, the makers of the Edge, and all the other Middle Eastern tribe that are a little bit suspect, if you ask me, but nonetheless they are going to grow. They're capturing all the sport, which is the entertainment, the circus and the bread and circus brigade. We're going to have all the richest soccer players there soon, if they aren't already there, every major sport, etc., etc. So the question was USD Korean won. So what happened with the dollar weakness? You've got to understand this is the longest and biggest setup that we've had in a massive time, and that you are on a monthly barely significant in terms of this. So this was our official triggering event. You go through multiple stages. You will learn more about this when you click on our mini series about something, the 5 stages of a breakout, as well as getting our newsletter. You trigger and you typically pull back. You see that? There's a green candle and it pulled back. It supported for a while, and then you had such a flush out on the dollar, you're back. The stop is down here. This only becomes a fail if you run this level down here. And in actual fact, the dollar has been climbing since the beginning of 2023 quite strongly, bar the yen trade unwind, the carry trade. We didn't discuss the carry trade. We've got to discuss the USD JPY, the fear indicator, and the carry trade. And it's been up, 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 and here you are. You are at the top end of the range on a current pullback. That's why I say, for all the people beating up on Brent Johnson with the dollar down, he is correct about the one thing, more than one thing I'd probably say. The structural design of the dollar is that you can get a major moon shoot when you have offshore dollars debt being collapsed, because they have to pay interest. And where do they get the dollars from? They have to destroy their currency and buy dollars. When you get a debt-based collapse for dollar-based denominated debt offshore, those people have to pay back in dollars, or they end up giving away a lot of very, very valuable assets at a bargain price. So typically we will still anticipate that this will run that level. Okay, that's what we anticipate. So 1,000 of you and 2 of you watching, this is a big, big squeeze. And South Korea will have its news-based event of some form that is going to destroy it. Right now, the dollar weakness is the story on the debt, and it can continue for a while longer. But never forget, this is more than a monthly candle chart. It's almost a quarterly setup. This is set up from before the millennium. This is huge. So this is just a minor little tickle and tick. We have what's known as the break and feign back in stage. Then we will make the first interim. Then you have melt up stage, and that's where you do the fancy footwork and you make all your money in single weeks, although you end up sitting months and months and months for that event to happen. That's unfortunately how it is. A lot of your profits all occur in very small percentage of your holding time, if this works out like it's supposed to. And that has a kind of lottery feel to it, because when you're winning, you're really winning, and you're winning big. Okay, so this is completely valid trade and remains that, and it's a cautionary that the design of the system still favors the possibility that despite the dollar being super weak, it can turn around and you can see volatility we haven't seen before in the FX markets and surge. So beware of that. And that will be very damaging for the rehoming of exports in America. Okay, what other questions do we have? Entries possible to come, yes. I'm not collecting any fun things for the collapse. I just believe in the most deeply value, clear, liquidity-based ones. You could collect baseball cards, and there might be a billionaire that says, hell yeah, I'll buy all your baseball cards off you. But without special skills and a real known hobby, it would not be my suggestion. If you don't really love it, and you don't have extremely good skills, and you can detect a fraud from not a fraud, because there will be a lot of skullduggery during this season, be aware. You want real certified pure gold, and there will always be a buyer. There will always be a buyer. We haven't spoken about platinum. We didn't speak about the yen. I'll do a quick fly by the yen and then we're going to let you go. What's been going on? The key part also, potentially, that people haven't discussed as much, and maybe it's being suppressed news, is that you could have some form of a neckline here for the Japanese yen. It's been a little bit toppy. And the thing is, people borrow in yen, they convert it to dollars, they pay a very low interest rate in Japan, and then they go and invest them in treasuries and get the spread differential. And generally, the dollar's also been going up, so their loan gets less valued. And then suddenly you have a major risking off. That's what happened in August, by the way, of last year. That's that sell-off there. And you are having a similar sell-off there. So you could, people who want to blame another nation, the dollar's down because Japan, because China are selling our stuff. Nobody appears to have materially sold off a great deal in any form. US institutions that borrowed in yen and don't like what's going down in their own country could be the cause, and could be selling off the treasuries, selling the dollar, and sending the yen back to pay off the loans. By the way, the Bank of Japan's lending rate just hit a new high. Still lower, a lot lower, but there was a tweet on that in our tweet feed that we were discussing, and there is clear signs of the yen interest rate going up. That's not a good position to be in. It's not a good position to be in, guys. Because that means the spread that everybody has borrowed, whether it went into Mag 7 or treasuries, is no longer as good. So I might not find it in a hurry, but watch out for that. Who do you think is smarter in this one, by the way? Foreign official demand for US stocks dump. Retail investors in America trained to BTFD are the record inflow. Not CEOs, not insiders. Who's the winner? Who do you back there? Which side do you want to be on? This time is different. The debt market will not come to the other asset classes' rescue. On housing, on stocks, on commercial property, on everything. Pensions are going to become a problem. This whole world of cards is going to come down. This is the first stage in a major sell-off. Okay, guys, thank you very much. Hit the like, give us a share. We appreciate. Hope you enjoyed the stream. Gold is king. Stay with the king. Gold is king, stay with the king. Do not use leverage if you're entering at these levels right now, by the way, because there has been a major move to the upside. Be very, very cautious. Watch if we get a little pennant or winding up structure somewhere here. You may then be able to, on a lower time frame, get a cheeky trade that could break you into the next upside move. For that, HVF method is king. You can find out how and what it's all about by clicking the book a call link, or even getting the mini series, or you can come and trade along with us as we use judicious small amounts of leverage to break into bigger move trades that have been winning us on the upside. The macro for gold, friends, let me just show you one more time so that you finish on this image and are left in no doubt. That candle is one of the most bullish candles you can ever see. In short, they tried. It opened where the other one closed. It tried selling off. It was rejected all the way back to where it opened and some. That is a look one way, 100% go the other way, a complete rejection. And we talk and we teach about that, and it's one of our breakout candle favorites in our HVF mini series and course. You will learn about it. That is big. And this is getting serious. From when we told at 2000, the gold story just gets more and more intense. From when we told you this is the moment to get leveraged, you have broken the continuation pattern. At 2011, you could have got in. $2,011, friends. You're at 3,224. Someone do the percentage move in that. 3,224, and the candles are starting to stretch. They're starting to stretch. This is fascinating. Okay, till next time, thank you very much. Watch out for a crypto live stream later on in the week. We'll talk to you about things like XRP and Bitcoin and other things. Until that point, we love you and leave you. I hope you enjoyed the intro. Let's hope they don't ring us for that. Remember, in the comments, watch out for the spam and report it if you see them. Until next time, we want to know what you think the year ends gold price. Your prediction, gold price, end of the year. 31st of December, winner gets a free live trading day. End of the year, which one? We'll take a screenshot of all those that leave answers, and we will contact you if you are the closest to the final year's finishing for the gold price. Okay, catch you next time. Bye for now.